What if the price of gold and silver is not telling you the real story? What if the real signal is hidden somewhere else? In the vaults, in the inventory numbers, in the quiet movement of physical metal from weak hands to strong hands. Because in times of chaos and financial stress, price becomes a weapon. It becomes a tool of misdirection. But inventory is a confession. Welcome to Gold Silver Scope, where we break down what is really happening in the gold and silver markets in simple, clear English, so you can understand the bigger picture without the noise. Right now, something unusual is building beneath the surface of the market. On the futures exchange in New York, there are roughly 81,000 open silver contracts. Each contract represents 5,000 ounces of silver. That means over 400 million ounces of paper silver exposure tied to one delivery month. Now compare that to the amount of silver actually available for delivery in the registered category inside the vaults. That number is just a little over 100 million ounces. Think about that carefully. Over 400 million ounces in paper claims. Around 100 million ounces in registered physical supply. This is not a small gap. This is a massive imbalance. Some people will say this is normal, that most contracts are settled in cash, and very few stand for delivery. And yes, that has historically been true. But what is different now is the behavior of large institutions. For many months, bigger and stronger players have consistently been standing for delivery. They are not heavily leveraged. They are not trading on thin margins. They have deep pockets. And when margin hikes pushed weaker traders out of the market, these stronger hands were quietly positioning themselves. We recently saw sharp price smashes in silver and gold. Prices fell aggressively in a short period of time. But then, something interesting happened. Within days, the price bounced back strongly. Volatility was extreme. This kind of move is not typical of a calm, balanced market. It suggests stress. It suggests forced liquidation. It suggests margin pressure. When exchanges raise margin requirements, leveraged traders are forced to either add more capital or sell their positions. Many cannot add capital quickly, so they are forced to sell. That creates sudden downward pressure on price. But while retail traders panic and sell, stronger institutions often step in and accumulate at lower prices. This is where inventory movement becomes more important than headline price. Because while the price was falling, physical metal was quietly being absorbed. Deliveries continued. Vault levels were under pressure. The number of entities that could potentially stand for delivery far exceeds the amount of metal sitting in the registered category. And this is not just a New York story. In London, similar tightness has been discussed for some time. Large open interest compared to limited immediately deliverable supply creates a fragile situation. It does not mean the exchange collapses tomorrow. It does not mean default is certain. But it does mean that the system is tight. And tight systems can become volatile very quickly. Now let us step back and think clearly. The bullish case here is not about a dramatic exchange failure. It is about something more simple and more powerful. It is about the price of immediacy. If too many players want physical metal at the same time, the market must raise the price high enough to convince current holders to sell. That is how markets balance supply and demand. So even if eligible metal exists in the vaults, that metal belongs to private owners. It is not automatically for sale. Registered metal is the only category that is ready to be delivered against futures contracts. And when registered inventory is thin compared to paper exposure, the pressure builds quietly. If even 10% of those 400 million paper ounces stand for delivery, that would be around 40 million ounces. That is a very large portion of the 100 million registered ounces. If 20% stand, the stress increases significantly. This is why the imbalance matters. Not because of panic headlines, but because of basic math. Meanwhile, demand inside the physical market has been extremely strong. Dealers, custodians, depositories, and shipping networks have all reported heavy volume. In some cases, business activity that would normally take months has been compressed into weeks. This kind of demand surge does not usually happen in a weak market. It happens when informed buyers believe something bigger is unfolding. And here is the key point. Most of the mainstream public is still not involved. The surge in demand is coming from those who already understand the system, who already see the cracks forming, and who are doubling down quietly. Price can be smashed in the short term. Charts can look ugly for a few days. But inventory trends, delivery data, and physical demand tell a deeper story. And right now, that story is pointing toward increasing volatility, tightening supply, and the potential for significantly higher prices ahead. Now, let us go deeper into what is happening behind the scenes, because the real stress in the system is not always visible on a price chart. It is visible in how the plumbing of the market is functioning. When silver and gold prices were rising aggressively, refiners were already under pressure. Many refiners operate in a market-neutral way. If they buy raw silver from the public or from miners, they hedge that position by selling futures contracts. This way, if the price falls, they are protected. If the price rises, they are also protected because the gain in physical is offset by the loss in futures. In theory, this keeps them balanced. But here is the problem. Even if they are market neutral, they are still subject to margin requirements on the futures side. When silver prices rise quickly, their hedge positions can generate margin calls. They must post more cash to maintain those positions. Now imagine this happening while exchanges are also increasing margin requirements at the same time. That creates a double squeeze. A refiner might be holding tens of millions of dollars worth of silver in the refining process. That metal takes time to move from raw form into finished bars. During that time, prices can move sharply. If margin calls come repeatedly and the required margin keeps increasing, the cash demand can become overwhelming. Even if the business is technically hedged and balanced, the short-term cash flow stress can become unbearable. As a result, many refiners slow down or completely stop taking new business. That removes liquidity from the physical supply chain. When refiners stop accepting new material, dealers feel the pressure. When dealers feel the pressure, delivery times extend. When delivery times extend, premiums can rise. The entire chain becomes tight. This is not a normal cooling-off period. It is mechanical stress in the system. Liquidity dries up. Timelines stretch. Everyone becomes more cautious. And in that kind of environment, small disruptions can create outsized price moves. At the same time, something very interesting happened during the recent price smash. As silver fell sharply, major institutions appeared to cover large short positions near the lows. In simple terms, they bought back contracts at depressed prices. That alone is notable. But it did not stop there. During the same period, shares of the large silver exchange-traded fund, iShares Silver Trust, expanded dramatically. Tens of millions of new shares were created in a very short time. Each share represents roughly a fraction of an ounce of silver. When new shares are created, authorized participants must first source physical metal and deliver it into the trust before shares are issued. This is critical. It means that during a moment of panic and forced selling, a large amount of physical silver was added into institutional vault structures. In other words, while retail investors were being shaken out, strong hands were accumulating metal and parking it inside controlled vehicles. This pattern suggests a transfer. Not a collapse in demand, but a shift in ownership. Silver moved from leveraged traders who could not handle margin pressure into institutions with deep balance sheets. Price weakness did not reflect weak fundamentals. It reflected forced liquidation. Now let us return to the futures exchange. There is often debate about eligible versus registered inventory. Eligible silver meets exchange standards but belongs to private owners. It is stored in approved vaults, but it is not automatically available for delivery. Registered silver, on the other hand, is specifically designated as deliverable against futures contracts. Some analysts argue that if pressure builds, eligible metal can simply be moved into registered status. Technically, that is true, but practically, it is not that simple. Much of that eligible metal is tightly held. It belongs to long-term investors, institutions, or clients who are not interested in selling at current prices. Even if we combine eligible and registered categories, the total barely matches the size of the paper exposure in some delivery months. And that assumes every ounce is willing to be mobilized, which is unlikely. The real issue is not whether the exchange defaults. The real issue is how high the price must rise to convince holders to part with their metal. This is what we mean by the price of immediacy. If someone urgently needs physical delivery, they may have to pay a premium. As delivery pressure increases, backwardation can appear, where near-term contracts trade at higher prices than longer-term ones. That is a sign of tight immediate supply. Now let us look beyond the West. In China, inventories on the Shanghai Gold Exchange have also been declining. At times, silver and gold prices in Shanghai have traded at noticeable premiums compared to Western benchmarks. Even after accounting for taxes and local factors, there have been persistent spreads. This creates an arbitrage incentive. If silver is meaningfully higher in Shanghai than in London or New York, metal will naturally flow eastward. Traders will buy in the lower-priced market and sell in the higher-priced one. Over time, that drains inventory from the cheaper region. Meanwhile, data from the London Bullion Market Association has also indicated tightness in vault holdings. When multiple major trading hubs show declining inventories at the same time, it is not random. It reflects strong global demand. The key takeaway is this: physical metal appears to be migrating towards stronger hands internationally. The West may still be setting the paper price, but the East is steadily absorbing supply. And when supply tightens globally, the paper market becomes more fragile. All of this points to one theme. Beneath the surface of price volatility, there is inventory stress. Beneath the headlines, there is mechanical pressure in the supply chain. And when systems are stretched like this, they do not gently rebalance. They snap into new price levels. Now let us bring everything together in a clear and simple way. We have a futures market with hundreds of millions of ounces in paper exposure. We have registered inventory that is only a fraction of that number. We have refiners under cash pressure because of margin hikes and rising volatility. We have strong physical demand from informed buyers. We have metal quietly flowing into institutional vaults during moments of panic. And we have declining inventories not only in New York and London, but also in Asia. Individually, each of these signals might not seem dramatic, but together they paint a picture of a market under strain. It is very important to understand something here. The bullish case for gold and silver does not require an exchange default. It does not require a dramatic headline event. It simply requires tightening supply and rising demand at the same time. When that happens, the only real solution the market has is higher prices. Let us go back to the math. If around 400 million ounces of silver are tied to a major delivery month, and only about 100 million ounces sit in the registered category, then even a moderate percentage of contract holders deciding to stand for delivery could remove a very large portion of available supply. If 10% stand, that is roughly 40 million ounces. If 20% stand, the stress becomes much more visible. Now imagine this happening in an environment where refiners are cautious, liquidity is reduced, and physical supply chains are already slow. In that situation, the market does not need panic. It only needs steady, persistent demand. And here is the interesting part. The majority of the mainstream public is still not deeply involved in gold and silver. The record activity we are seeing has largely come from investors who already understand the system. These are not emotional buyers chasing headlines. These are strategic accumulators responding to structural signals. When price gets smashed sharply and then rebounds quickly, that is often a sign of forced liquidation, followed by strong underlying demand. Weak hands are pushed out, strong hands step in, metal moves from leveraged accounts into vaults controlled by institutions or long-term holders. This is not weakness, it is a transfer of ownership. We also need to consider global flows. When silver trades at a premium in Asia compared to Western markets, it creates a powerful incentive for metal to move east. Over time, this can drain available supply from Western vaults. And if Western exchanges continue to set the benchmark price using paper contracts, while physical supply quietly tightens, the disconnect grows. Markets can function like this for a long time, but the tighter the system becomes, the more sensitive it is to shocks. A geopolitical event, a sudden surge in investment demand, or a shift in currency markets could be enough to tip the balance. When inventories are thin, it does not take a massive catalyst. It only takes a spark. This is why volatility may increase before things stabilize. When supply is tight and leverage has been flushed out, price can move quickly in both directions. Short-term drops can still happen. Margin events can still create sudden sell-offs. But if the structural imbalance remains, those dips may continue to be absorbed by stronger buyers. Ultimately, the key concept is simple. Inventory tells the truth. Price can be pushed around in the short term. It can be influenced by leverage, algorithms, and emotional reactions. But physical metal in vaults cannot be faked. When registered supply shrinks and demand persists, the pressure builds quietly. At some point, the market has to raise the price enough to bring new supply forward, or to convince current holders to sell. That process can take time. It can be messy. But history shows that when physical markets tighten significantly, the adjustment is not small. For long-term investors, the question is not whether there will be volatility. There will be. The real question is whether the structural direction favors higher prices over time. Based on delivery data, inventory trends, global arbitrage flows, and institutional accumulation patterns, the foundation for higher prices appears to be strengthening rather than weakening. That does not mean prices go straight up tomorrow. It means the imbalance is building. And when imbalances grow large enough, markets eventually respond. If you found this breakdown helpful and want deeper, clear analysis on gold and silver without hype or noise, make sure you subscribe to Gold Silver Scope and stay connected with our updates. We focus on real data, real inventory movements, and the structural forces shaping this market. And as always, this content is for educational and informational purposes only. It is not financial advice. Every investor should do their own research and consider their own financial situation before making any investment decisions. The gold and silver story is far from over. In fact, it may just be entering its most important phase.